Hello, my dear students. Lucas Commerce Academy, the power of accounting welcomes you. In last video, we have discussed fixed installment method. Now, we are going to discuss diminishing balance method or reducing balance method or written down value method. This is the second method. This method is an improvement over the fixed installment method. But how this method is improved over the fixed installment method, let us discuss in next video. Okay. Under this method, a fixed percentage of depreciation is calculated on the book value of the asset. On the book value, the powerful word is book value of the asset. What is book value? Okay. So under this method, a fixed percentage of depreciation is calculated on the book value of the asset every year. On the book value of the asset every year. This book value is also known as written down value, diminishing value, or reducing balance value. Okay. So what is book value? So book value is nothing but the value which appears at the beginning of the every year. At the beginning of the every year. Once again, book value means the value which appears at the beginning of the every year. So that means 1,20,000 is the beginning of the first year. So this is the book value. Come to second year, 1,08,000. This is the beginning value. So this is book value. So next third year, this is the book value. Fourth year, this is the book value. On this value, we are going to provide depreciation at a fixed percentage. At a fixed percentage. Okay. So once again, book value or written down value or diminishing value or reducing balance value all are same. So what is book value? The value which appears at the beginning of the every year is known as book value. So here beginning value 1,20,000 is the book value. So here at the beginning of the year 1,08,000, this is the book value, this is the book value, this is the book value. On this value, we are going to provide a fixed percentage of depreciation. Okay. Then let us discuss the problem. Okay. Take this problem. So that means this is the diminishing balance method. Diminishing balance method or written down value method. Or written down value method. So come to problem. So MR traders purchased a machinery on 1/1/2020 at a cost of rupees 1 lakh. Okay, so usual journal entry, machinery account data to bank account 1 lakh. Next, and spent rupees 20,000 for its transport and installation. Same entry, same as in the case of fixed installment method. Machinery account data to cash or bank account. So depreciation is provided 10% per annum annually on WDV method, that means written down value method or diminishing balance method. Okay, so the books are closed on 31st December every year. So this is the very important, already told you. Okay, prepare machinery account for first 4 years. So under this method, a fixed percentage of depreciation is provided on the book value of the asset at the beginning of the every year. Okay, come to. So first, when asset is purchased, the journal entry, machinery account data to bank 1/1/2020 to bank account to 1 lakh. Then installation and transport charges incurred. Machinery account data to cash or bank account. So come to on 31st/12/2020. That means no further transaction takes place between 1/1/2020 to 31st/12/2020. Hence, we are providing depreciation. So 31st/12/2020 by depreciation account. So the value which appears at the beginning 1,20,000, 1,20,000 to 10 by 100, 12,000. Okay. So then debit side is more 1,20,000. The same is transferred this side. From this amount deduct 12,000, we get 1,08,000. The same brought forward to next period 1/1/2021 balance C by D. So this is 1,08,000. On this figure, we are going to calculate depreciation under this method. So that means, so here the book value 1,08,000 into 10%, 10 by 100. Okay. So that means 10,800. 10,800. Now the balance 1,08,000. The same is transferred to this side 1,08,000. So then let me use calculator. So 1,08,000 minus 10,800. So the balance is C by D 97,200. Then brought forward to here. 1/1/2022 97,200. So this is the book value. In third year, we are going to provide depreciation on this book value. That means 97,200, 97,200 into 10%, 10 by 100. So that means 9,720. Okay, so the balance is, so minus 9,720. So that means 87,480. So 87,480. Then the total 97,200. 97,200. Brought forward 87,480. Okay, so this is the book value. On this, we are going to provide depreciation 87,480 into 10 by 100. So that means 8,748. Then the total is 87,480. The same is transferred to this side 87,480. Deduct 8,748. Okay, so the resulting figure is 78,732. So this is the balance brought forward on 1/1/2024, 78,732. Okay, so this is the procedure for doing problem under diminishing balance method. Okay, so here the powerful word is book value or diminishing value or written down value or reducing balance value. So book value means the value which appears at the beginning of the every year, on which on that figure we are going to calculate depreciation. So that means first year 1,20,000 is the book value, 1,20,000 to 10 by 100 12,000. So the resulting figure balance 1,08,000. Next come to first year, then come to second year. This is the opening balance 1,08,000. On this figure we are going to calculate depreciation 1,08,000 to 10 by 100 10,800. So the resulting figure is 97,200. So brought forward to third year. So that means this is the book value. On this value we are going to provide depreciation. So 9,720, balance brought forward 87,480. So this is the book value. On this 87,480 into 10 by 100, 8,748. The resulting figure or balance C by D 78,320. The balance is 78,732. 732. So this is the procedure for doing the problem under diminishing balance method. Diminishing balance method. So next, suppose if the asset is purchased in the middle of the year, what should be done? So the procedure is same as in the case of fixed installment method. Fixed installment method. So if the asset is purchased 1/7/2020, we have to provide depreciation for only 6 months for first year, second year full year, third year full year, fourth year also full year. Suppose if the asset is purchased on 1/4/2020, that means from April 1st to December 31st, 2020, 9 months we are providing depreciation. Next, suppose if the asset is purchased on 1/10/2020, then depreciation is calculated only for 3 months. Then comes second, third, fourth year, full year depreciation. We are providing full year depreciation. So this is the problem. Okay, so this is the procedure for doing the problem under diminishing balance method. Okay, so diminishing balance means the value which appears at the beginning of the every year. On this figure we are going to provide depreciation. Okay, this is the specialty of this method. So under this method the amount of depreciation is decreasing from year to year. First year depreciation 12,000, second year 10,800, third year 9,720, fourth year 8,748. But in case of fixed installment method, the amount of depreciation is constant or fixed. Okay, got it. So in next video, we are going to discuss sale of asset both under fixed installment method and diminishing balance method. Okay, till then, thank you very much.